Welcome back to Handsome Trader. So have you ever wanted to jump into crypto or tokenized markets only to log into an exchange and feel like, well, like you're staring at the control panel of a space shuttle?
Oh, yeah. It's totally overwhelming.
Right. There are flashing numbers everywhere, a million tabs cascading down the screen, and you just know deep down that one wrong click is going to send your entire portfolio into a black hole.
It is honestly a profoundly intimidating experience the first time you load up a professional trading interface. The sensory overload alone is enough to make a lot of people just, close the laptop and walk away.
And that is exactly what we're going to fix today. But really quickly, if you find value in the breakdowns we do here, please take a half second to like, share, and subscribe to the channel. We put a lot of heart into unpacking these complex topics, and honestly, your support genuinely keeps this channel growing.
It really makes a massive difference.
It does.
Mm-hmm.
So our mission for today's deep dive, we are creating a comprehensive, step-by-step guide on how to actually navigate and trade on Delta Exchange. We're going to take this seemingly clunky, highly technical process and turn it into a smooth, manageable workflow for you.
Which is so crucial.
Exactly. And to do that, I'm joined by a resident veteran trader who specializes not just in the cold, hard mechanics of the market, but, the psychology behind every single click.
Well, it is great to be here, and psychology is really the underlying current of everything we are going to discuss today, because a trading platform is, at the end of the day, just a piece of software.
Right.
How you interact with that software when your heart rate is elevated, that is what determines your longevity as an investor.
I love that. Let's start right there, actually, with the friction of getting started. Because before you can even think about executing a master-level trade, you have to actually get your money onto the platform.
Yeah, the dreaded deposit gateway.
Exactly. There is this massive roadblock that catches almost everyone off guard. If you try to add funds, the deposit will automatically fail if the bank account you use to transfer the money doesn't perfectly match the exact bank account you registered with when you open the exchange account.
Down to the exact letter.
Right. Not a digit, not a middle initial out of place. It honestly reminds me of showing up to an exclusive VIP club.
Oh, that's a good analogy.
You've got a prepaid ticket, you're wearing the right clothes, but the ticket is under your spouse's name, or maybe your LLC's name. And the bouncer at the door just does not care. He crosses his arms and says, nope, you are not getting in.
Yeah, the bouncer is not impressed.
Not at all. So I have to push back on this a bit. I mean, is this just broken, clunky platform design? Why the intense strictness?
It feels like unnecessary bureaucracy, for sure, especially when you just want to get your capital to work. But this is actually a non-negotiable regulatory armor. Financial regulators in the US and Europe, well, they watch cryptocurrency exchanges like hawks.
Right, they really do.
So these platforms have strict anti-money laundering, or AML, protocols. The platform has to mathematically prove that the money coming in belongs to the verified individual who owns the account. If they start allowing funds to flow in from third-party accounts, corporate accounts, or a spouse's account, they instantly become a target for money laundering, and boom, they lose their license to operate.
Okay, so the bouncer isn't just being a jerk. The bouncer is making sure the club doesn't get shut down by the authorities.
Precisely. But let's look at the psychological toll this takes on a trader. Just imagine this scenario. You have been analyzing the charts all week. You finally see the perfect market setup forming. The entry point is right there.
Oh, man.
You rush to deposit funds from a secondary bank account and blocked. Admin error. The bouncer says no.
Your cortisol levels would just go through the roof.
Oh, absolutely.
Yeah.
You spend the next 2 hours fighting with customer support or waiting for your bank to reverse the wire transfer. And by the time your money finally clears and sits in your account, your perfect trade setup is long gone.
The market has moved right without you.
Exactly. And what does the amateur trader do in that exact moment?
Oh, I know this one.
Yeah.
They force a trade just to feel like they didn't waste their time.
They execute a revenge trade. They are so frustrated by the administrative friction that they jump into a terrible, uncalculated position just to feel productive.
Wow, yeah.
So the strict bank rule isn't just a regulatory hurdle. It is your very first psychological test. You have to set your funding up correctly, in advance, in peacetime.
In peacetime, I like that.
Yeah, you want your capital locked and loaded before the market ever gives you a signal, so you aren't fighting the bouncer when you should be executing your strategy.
That is a crucial reframe. Set up in peacetime. Okay, so let's say we've passed the bouncer.
Yeah.
Our funds are sitting safely in the account.
We're inside the club.
We are in. Now it's time to look at what is actually on the menu inside. When you explore the Market tab on Delta Exchange, you see the usual heavy hitters, right? Options, futures, your Bitcoin, your Ethereum.
The classic.
Right. But then there's this entirely separate category called real-world tokens. And this blew my mind a little bit. You can trade tokenized versions of traditional shares, like Tesla and Amazon, right alongside your crypto assets.
Yeah, this is where the entire landscape of modern investing is really shifting. We are seeing the convergence of two completely different financial worlds on one single screen.
But why does that matter so much for a standard investor? Like, why is that such a big deal?
Well, think about the traditional friction. Historically, if you made a solid profit on Bitcoin and wanted to park some of those gains in a traditional tech equity like Amazon, you have to sell your crypto, wait for the cash to settle, wire it to a traditional brokerage.
Thus, the wire transfers.
Right, wait for that to clear, and then finally buy the stock.
Yeah.
It took days. Real-world tokens act as a massive bridge. You don't have to leave the digital ecosystem to get exposure to traditional equities.
This unifies your whole portfolio.
Exactly.
But, regardless of what asset you decide to trade, you have to decide how you're going to look at it. And this brings up the great desktop versus mobile debate.
Oh boy, here we go.
Yeah. So the platform has a highly rated mobile app with all the features unlocked, yet any serious guide will tell you that chart analysis is vastly superior on a laptop or a tablet.
Absolutely.
But we are constantly sold this dream of the trader on the beach, right? The guy with a pina colada in one hand, making thousands of dollars on his phone with the other. I mean, isn't doing serious technical analysis on a 6-inch glass screen just asking for trouble?
It is asking for absolute disaster. We really need to separate marketing fiction from practical reality here. Mobile apps for trading are fantastic, essential tools, but their primary utility is defense, not offense.
Defense versus offense. Okay, break that down for me.
Offense is finding the trade. Offense requires a wide monitor, a proper workspace, and a calm environment. Defense is what the mobile app is for.
So like checking in on things.
Exactly. A mobile app is for monitoring an active position while you are away from your desk. It is your emergency exit button. If you are getting coffee and the market suddenly turns violently against you, you pull out your phone and cut your losses.
Makes total sense.
But trying to draw complex Fibonacci retracements or plotting nuanced support zones with your thumb while walking down the street, you miss critical data. You fat finger a trend line.
Yeah. You literally can't see the wider context.
You really can't. And this platform offers powerful tools that require that wider context. For instance, you have access to indicators like the EMA, the exponential moving average.
Right.
Unlike a simple moving average, the EMA gives more weight to recent price data, meaning it reacts faster to sudden market shifts. Or the super trend indicator, which visually flips from green to red to give you a clear algorithmic signal of when a trend is breaking down.
I mean, trying to cram a price chart, an EMA line, and a super trend indicator onto a phone screen sounds like an absolute nightmare.
It's just visual noise. Furthermore, you have to consider your time frames. The crypto market is 204/7. It does not sleep.
Never.
When you are on a desktop, you can comfortably split your screen. You can look at a 15-minute time frame for intraday trading, which is sort of like looking at the ripples on the water. And right next to it, you can have a 4-hour time frame for swing trading, which shows you the actual tide.
Oh, that's a great way to put it. Ripples versus the tide.
Yeah, you need a proper workspace to synthesize that information. And frankly, before you even risk a single real dollar, you should be utilizing the platform's demo trading feature.
The simulator. Using practice dollars.
Exactly. You get to feel the rhythm of the platform, test those indicators, and make all your clumsy fat finger mistakes with fake money.
Right. Highly recommend the fake money mistakes.
Yeah.
So our workspace is set up. We are on our laptop. We've practiced in the simulator, and we've done our analysis. Now it's time to actually pull the trigger on a live trade.
The moment of truth.
Right. And this means dealing with the core mechanics, like lot sizes and order types. And the terminology here can really trip people up. We know going long means buying, hoping the price goes up. Going short means selling, hoping the price drops.
They spell.
But this exchange uses a specific lot sizing system. It takes 1,000 lots to equal 1 whole Bitcoin. And it takes 100 lots to equal 1 Ethereum.
Correct.
Why overcomplicate it, though? Like, why not just say, hey, I want to buy 0.05 Bitcoin?
Well, it actually does the exact opposite of overcomplicating it. It removes mental friction.
Really? How so?
Let's use a pie analogy. Imagine Bitcoin is a massive pie currently priced at $80,000. Most retail traders aren't buying a whole pie.
Definitely not.
So instead of forcing you to type in an awkward, anxiety-inducing fraction like trying to buy 0.0125 of a pie, the platform pre-cuts the pie into 1,000 standardized slices.
Oh, I see. So if Bitcoin is at $80,000, one slice is essentially $80.
Yes. It is profoundly easier for the human brain to process the thought, I am going to buy 15 lots, than it is to calculate decimal points in your head while a chart is moving rapidly. It just standardizes the math.
Okay, that makes total sense when you frame it as slices. Now, when you go to place that order for those lots, you have choices.
You do.
A market order is brute force. It simply executes your trade immediately at whatever the current price is right this second, which I guess can sometimes mean you pay a slightly worse price if the market is moving fast.
Slippage, exactly.
Right. A limit order lets you name your exact price and wait for the market to come to you. But there is a tool here called Best Bid that really caught my eye.
Oh, the best bid feature is an incredible way to reduce cognitive load.
Right. Instead of manually typing in, say, $80,942 and praying you didn't accidentally type $89,000.
Which happens more than you'd think.
I bet. But clicking Best Bid automatically selects an optimal limit price for you, right near the current action. It ensures you get a quick fill without paying a premium or making a massive typo.
Exactly. In high-stakes trading, every time you have to manually type a string of numbers, you introduce the possibility of catastrophic human error. The platform is literally trying to save you from yourself.
But speaking of saving you from yourself, we have to talk about the most dangerous tool on the entire platform, leverage.
Ah, yes. The ultimate double-edged sword.
Delta Exchange offers up to 200x leverage, meaning if you put up just a tiny amount of your own capital, the exchange multiplies your buying power by 200.
It's massive.
You could buy 148 lots of Bitcoin with almost nothing. But every piece of guidance screams that the absolute maximum recommended for beginners is 25x. And honestly, even 25x sounds terrifying to me.
As it should.
The way I view 200x leverage is like driving a high-performance sports car 200 miles per hour through a crowded residential neighborhood. Every tiny microscopic movement of the steering wheel is violently amplified. You twitch and you wrap the car around a tree.
That is spot on. And to build on that metaphor, you don't even own the car. The exchange owns the car. They lent it to you. So the second they think you are going to scratch the paint, which represents their capital, they are going to eject you from the driver's seat entirely.
Wow. That is a terrifying thought. Why do platforms even offer 200x if it's that dangerous?
Because human psychology demands it. When a novice trader sees 200x, their brain instantly and exclusively calculates the potential reward. They think, well, if Bitcoin moves up just 0.5%, I double my entire account.
Yeah, that does sound tempting.
Right. The human brain is incredibly skilled at developing risk blindness when it is fixated on a massive immediate payout.
We only see the finish line. We completely ignore the potholes.
Which is why capping your leverage at 25x, or ideally much lower when you start, is about survival. Markets breathe. They move up and down in natural waves of volatility.
Right.
If you are at 200x leverage, in normal market breath, a tiny fluctuation against your position will completely wipe out your account. By keeping your leverage low, you allow yourself to survive the normal turbulence of the market so your actual strategy has time to play out.
Okay, so let's say we are being disciplined. We take a sensible, low-leverage trade. The order is live. Now comes the hard part, trade management.
The waiting game.
Yeah. Traditionally, managing risk means staring at your keyboard, manually typing in the exact price you want to take profit, manually typing in the exact price you want to cut your losses, and again, hoping you didn't miss a zero.
Which introduces high-stress cognitive load right when you are most vulnerable.
But this platform has a visual drag-and-drop management system. Instead of typing that your stop loss should be at $80,000, you just click SL on your chart, and you literally drag a physical line down to where you want it.
It is incredibly intuitive.
Same for the take profit.
Yeah.
You drag a line up. If you want to cancel the stop loss entirely, you just click the little X on the line. It's instant.
Yeah.
But is this really that much of an upgrade? Or is it just kind of a gimmick?
Oh, it is a massive psychological upgrade. Beyond just the speed of not having to click through 3 drop-down menus while a trade is going south, there is a profound neuroscience benefit here.
Really? Neuroscience?
Absolutely. When you type numbers into a box, those numbers remain abstract. $80,000 is just a concept in your mind. But when you physically drag a line onto your chart, placing it just below a visible level of support, you are mapping out your risk in physical space.
You're creating a visual boundary.
You are literally building a fence. You can see the floor. It removes the abstract nature of the math. When a trader can physically see their risk parameters drawn out in front of them, the amygdala, the fear center of the brain, actually calms down.
Wow, that's fascinating.
It is. You know exactly where the cliff is, which vastly reduces that mid-trade panic where you make irrational decisions.
I love that. You build a fence so your brain can relax. But even with those visual boundaries set, there is a hidden trapdoor built into the very nature of leverage trading. And it's a trapdoor the exchange controls entirely.
Ah, yes. Liquidation. Silent killer.
We really need to explain the mechanics of this crystal clear. Because you are using leverage, the exchange is effectively lending you money. If you put up $100 of your own money and you use 25x leverage, you are trading with a position size of $2,500.
Right.
$2,400 of that belongs to the exchange.
Right.
And as you said earlier, they own the car. They are not running a charity here.
They will protect their capital at all costs.
Exactly. The exchange will automatically force close your trade if the price drops too much, simply to ensure they don't lose their portion of the money. That forced close is your liquidation price. Let's look at the math real quick.
Go for it.
Say Bitcoin is at $81,000,
Yeah.
and you are shorting it, betting it will go down. With a safe 25x leverage, your liquidation price might be far away, up at $84,000. You have thousands of dollars of breathing room.
Which is comfortable.
Right, but if you take that 200x leverage, your liquidation price might be at $82,000.
A tiny bump in the wrong direction.
A microscopic bump, and the exchange instantly wipes out your entire position. Now, I understand you could adjust this mid-trade, right? Like, the platform allows you to add or remove margin while the trade is active.
Yes, you can think of adding margin like throwing more sandbags onto a levee.
Okay, I like that visual.
If the water is rising and getting close to your liquidation price, you can lock up more of your available funds to push that liquidation price further away. Conversely, if the trade is deeply in profit, you can remove margin to free up capital for other trades.
Right.
But relying on adding margin to save a losing trade is a very, very slippery slope.
Because you're just throwing good money after bad.
Exactly.
So the liquidation price is essentially the exchange's automated self-defense mechanism kicking in before you can lose their money.
And one that lacks any empathy whatsoever for your portfolio, which is why placing a hard stop loss is absolutely non-negotiable.
Right. Use that drag and drop tool we talked about.
Exactly. A disciplined trader dictates their own exit on their own terms. If you are wrong about a trade, you want to take a small calculated loss that you decided on in advance. You hit your own visual fence.
You are in control.
Always. You never, ever let the exchange's automated liquidation algorithm make the decision for you. Surrendering to liquidation means you have lost total control of your risk management.
Taking agency over your exits, you have to be the one steering the ship. Well, we are just about out of time, but I want to mention a great bonus piece of info for the workflow we've been discussing today.
Oh, yes, the promotion.
Right. If you happen to open an account through specific promotional links from the source we reviewed, it often provides a premium subscription to a tool called Adhera AI. It is a one-click AI chart analysis tool valued at around $25. You usually just have to fill out a brief Google form with your user ID after signing up. It sounds like a pretty incredible tool to add to the arsenal, especially for streamlining that desktop analysis we were talking about.
It really is a powerful supplemental tool. But before we wrap up, I need to make something explicitly clear to everyone listening right now. The content shared in this deep dive is strictly for educational purposes and sharing personal experience. It is absolutely not investment advice. Financial investing always carries risk. You, the viewer, must do your own thorough research and take full responsibility for all your trading decisions.
Perfectly stated. You are the captain of your own ship, and no algorithm or podcast can change that. So to wrap this all up, we started by talking about how intimidating the control panel of a trading platform can feel. The blinking lights, the sensory overload.
The space shuttle.
The space shuttle, exactly. But as we've seen, features like pre-calculated lot slices, best bid order matching, and visual drag-and-drop risk management have made the actual mechanics of trading smoother than ever before. Which leaves you with one final thought to ponder as you look at the markets this week.
What's that?
If modern platforms are making it this incredibly easy and frictionless to execute and adjust trades visually, well, does that ease of use actually make it harder to maintain the psychological discipline not to overtrade?
Wow. Friction often creates a pause for thought, When you remove the friction, you really have to supply your own discipline.
A dangerous comfort indeed. Until next time, stay sharp, respect your risk, and thanks for joining us on the Deep Dive.